Markets had a lot to digest during the second quarter of 2018, including the growing threat of international trade wars, chaotic Italian politics, and a powerful rebound in the US dollar. This kept volatility at elevated levels, far above what we saw over the course of last year, meaning asset class returns diverged significantly. For instance, UK and Australian equity markets posted gains of around 9%, but Asian equities fell 6%. This goes most of the way towards explaining divergence across the returns of the Harmoney portfolios over the quarter. The sterling and Australian dollar funds led the way with gains of 3 to 5%, while the Asian funds both fell by approximately 2.5%. The remaining US dollar and euro funds achieved modest returns of between 0.3 and 1.7%, reflecting low but positive gains in their respective equity markets. The US dollar gained around 5% versus most other major currencies over the quarter, which was a leading driver of the weakness we saw in emerging market assets, but also meant there were big differences between local currency returns and those measured in dollars. In terms of performance attribution, equity manager selection contributed meaningfully to performance across most of the funds. A couple of highlights include Contrarius, a holding that was introduced across all of the funds earlier this year, and Granahan, held in just the US dollar funds. These holdings gained 14% and 18% respectively over the quarter in dollar terms, driven by excellent stock selection by the underlying managers. Our Asian and emerging market equity managers also performed well, protecting capital or even achieving small gains in absolute terms, despite the large falls felt across their markets, which highlights another side of the value that the best actively managed strategies can offer, in the form of greater downside protection and lower variability of returns compared to passive index tracking strategies. We implemented several changes in the fixed income portions of portfolios during the quarter. At a high level, we sold most of our remaining allocations to corporate credit, which had performed very well for us for several years, but now look relatively expensive. We also sold our longer-dated inflation-linked US government bonds, or TIPS as they're known, which also performed well due to longer-term inflation expectations for the US economy increasing meaningfully, to levels we see as being around fair value, versus the cheap levels we were able to buy them at. We've recycled more or less all of these proceeds into a 2023 US Treasury bond, yielding almost 2.9% at the time. As policy rates have gradually been increasing in the US, government bonds in this maturity range have sold off sharply, which created what we believe to be a decent buying opportunity. For context, this same bond was yielding just 1.8% less than a year ago. Although the clear trend is towards rising bond yields globally, we've introduced positions of up to 6% in this issue, depending on the portfolio risk profile, in recognition of the good relative value this offers versus most other bond markets, and the significant diversification benefit Treasuries bring as some of the ultimate safe haven assets. In addition, we introduced a new equity holding in the Harmoney Europe Diversified Fund, which is the Magellanes European Equity Fund, at a 10% weighting. Magellanes is a Madrid-based, deep value-orientated manager that we've conducted extensive due diligence on and consider to be truly world-class in their area of expertise. Introducing their strategy improves the style balance within the fund at a time when we believe the longer-term prospects for value strategies is good. Indeed, on some measures, the recent period represents the most value styles have ever underperformed by, on a global basis, since the 1930s. The global economy remains in good shape, with steady growth and modestly rising inflation, supported by accommodative central bank policy. We've been through a slightly soft patch in the first quarter, but economic indicators are generally improving again now. Markets are undoubtedly more vulnerable to setbacks and greater volatility than in 2017, but this is largely reflected in valuations, which makes today's entry point more attractive. Overall, we believe it remains appropriate to stay invested, building greater resilience in portfolios through more defensive assets, while at the same time taking advantage of valuation opportunities as they arise.